Understanding demand is crucial when analyzing consumer behavior. It refers to the relationship between price and the number of goods consumers want to buy during a specific period, assuming all other factors remain constant. The demand schedule, a table displaying demand data, and the demand curve, a graph representing the same information, are essential for analyzing demand. Law of demand. According to the law of demand, when a goods price increases, its demand decreases. Therefore, the demand curve should slope downward to reflect this relationship. However, it's crucial to remember that other factors such as consumer preferences, income, the number of consumers in the market, expectations of future prices, and the cost of related goods can also impact the quantity demanded of an interest. Factors impacting demand. Consumer preferences and information, for instance, can significantly impact the demand for goods and services. For example, the fear of flying after September 11 decreased the need for air travel, while the popularity of the Atkins diet resulted in a decline in demand of Krispy Kreme donuts. Similarly, changes in consumer income can affect demand for goods with luxury items like jewelry, experiencing an increase in demand when incomes rise. The number of consumers in the market and the prices of closely related interests, whether substitutes or complements, can also impact demand. An increase in the price of one good will lead to a decrease in its complementary product, while an increase in the price of a substitute will lead to a rise in demand for the other good. movement versus shift of demand curve. Understanding the impact of price changes and shifts in demand and supply is essential in evaluating the market's behavior. When the price of a good decreases, the quantity demanded increases and vice versa. A shift in demand is brought about by factors other than the price of the good, such as consumer preference, population increase, or expected future price changes. The law of supply. On the other hand, the supply of a good relates to the quantity supplied at different prices. The law of supply dictates that as the price of good increases, the amount provided also increases. Factors impacting supply. Factors affecting supply include technology, input prices, the number of firms, expectations, and government regulations. Technological advancements can significantly impact supply. A firm can produce more goods with the same inputs, prompting it to make more at the same price. However, expensive inputs such as raw materials, land, and capital can increase the cost of production, causing the firm to sell less at a given price. The number of firms in the market can affect supply with an increase, leading to more goods and services available for sale at each price. Factors impacting supply. A firm's expectation of future prices can also impact supply, with sellers holding back when they expect prices to rise and selling more if prices are expected to drop. Government regulations such as taxes, subsidies, and rules can also impact supply, with an increase in taxes or a decrease in grants, reducing the quantity firms are willing to sell at a given price. Movement versus shift of supply curve. A movement along the supply curve shows a change in the quantity supplied brought about by a change in price. A price increase is a movement from point E to F on the same supply curve, while a decrease is from point F to E. A shift to the right illustrates an increase in supply, while a change to the left demonstrates a reduction. The possible causes of a rightward shift in the supply curve include better technology, less expensive inputs, more firms, lower expected prices in the future, more subsidies, or less tax. Alternatively, deteriorating technology, more costly inputs, fewer firms, higher expected costs in the future, fewer subsidies, or more taxes can cause a leftward shift in the supply curve. Market equilibrium. The interaction between consumers and producers determines an equilibrium price in the market. This is where the quantity supplied equals the quantity demanded, resulting in a balance. Shortage, also known as excess demand, occurs when the demand exceeds the amount supplied due to the market price being below the equilibrium price. On the other hand, surplus, also known as excess supply, occurs when the quantity supplied exceeds the quantity demanded due to the market price being above the equilibrium price.